Welcome to this explainer. Today, we are jumping straight into the ring with two absolutely legendary investing philosophies. And the crazy thing? They completely disagree on the most basic rule of buying stocks. I mean, one tells you to never buy an expensive stock, while the other insists that the absolute best stocks to buy are the ones already breaking out to new highs. Both strategies have made massive fortunes, and yeah, both have totally blown fortunes up too.
So let's dive right into this heavyweight clash. Over in the left corner, we've got value investing, which is built entirely on that classic mantra you've probably heard a million times. Buy low, sell high. But over in the right corner, we have growth investing. And growth advocates something that feels completely counterintuitive. Buy high, sell higher. This clash really exists because there are genuinely two distinct, mathematically sound ways to pull a profit from a stock.
Let's break them down. Value investing, which is championed by legends like Warren Buffett, focuses strictly on patience. It's kind of like a giant puzzle. Your entire goal is finding a company that is trading for meaningfully less than its calculated intrinsic value. Basically, you're buying it at a steep discount, for way less than it's worth on paper. Then you lock it in, you hold it, and you just wait for the broader market to eventually wake up and price it correctly.
On the flip side, we have growth investing. Pioneered by experts like Bill O'Neill, this operates on a totally different wavelength. Here you take action precisely because the market already agrees with you. You aren't waiting around for anyone to wake up. Instead, you're looking for stocks actively breaking through a price resistance ceiling on really heavy volume. You're betting that a confirmed breakout in a trending market is just going to keep running.
So, what does this all mean for you? Well, here is the absolute crucial takeaway. Neither philosophy is inherently right or wrong in a vacuum. The difference isn't which philosophy is quote-unquote right, it's which market you're standing in when you use it. The real secret to wealth preservation lies in picking the correct tool for the current market cycle rather than just blindly following a specific guru's dogma.
And this requires a real paradigm shift in how we think. You see, growth investing is your absolute best weapon specifically in trending bull markets, where the macroeconomic tide is running strongly in your favor. Those momentum breakouts work beautifully there. Conversely, relying on the value philosophy in a bear market, well, that can be an incredibly dangerous trap.
Actually, let me issue a quick mentor's warning right here to explain exactly why value is so dangerous during a downturn. A stock that looks wonderfully cheap on paper during a market crash might actually represent a fundamentally broken business. In a bear market, an attractively priced stock at a 52-week low can easily fall all the way to zero. Seriously, it's not just cheap, the business itself might literally be dying.
Okay, let's test this concept out with a quick pop quiz to make sure we're really actively applying these rules. Imagine this scenario for a second. The broader market is in a confirmed late bear phase. You're looking at the charts, and you find a stock sitting at a 52-week low, priced way below its book value. It looks like the ultimate value play. So, do you buy it?
The answer is absolutely not, because as we've just learned, cheap does not equal safe. In a bear market, macro fear completely overrides individual company quality. Everything just moves downward together. Buying an apparently cheap stock in a terrible market without any technical confirmation, you're basically just catching a falling knife.
Now, once you've chosen between value and growth, you have to introduce a second dimension of stock selection, which is company size. You literally have to match the size of the company to your exact cycle phase. For example, small-cap stocks, those emerging companies between $250 million and $1 billion, historically outperform in early bull markets when risk appetite is super high. Mid-caps offer a nice middle ground, but if you're in a late bear market, you want defensive exposure, meaning you should be moving to large-cap blue-chip companies for shelter.
Before we wrap up this explainer, I want to leave you with a pretty provocative thought. Take a hard look at your own portfolio right now. Are you risking your hard-earned capital by using the wrong investing tool for the current market tide? Are you trying to force a growth strategy in a choppy market? Or maybe assuming a cheap value stock is totally safe when the macro environment is collapsing? Knowing what to buy is only half the equation, right? Knowing the ocean you're sailing in is how you actually keep your wealth. We'll explore that even deeper in part 2.